Hi, I'm delighted to be with you here again. I'm going to be asking and answering the question that I believe a lot of people want answers to. The question is, what do you do when you're in a market cycle that is on the negative? In other words, what do you do in a down cycle? When there is a market correction, whether that be in real assets, whether that be in securities, or whether that be in digital assets, cryptocurrencies. What do you do when there's a market correction? When there's a bear market, what should you do? Now, unfortunately, I can't give you financial advice, but what I'd like to do in the next few minutes is share some of my thoughts and share some of my experiences with you, and hopefully, perhaps, I hope, you might find some words of encouragement, perhaps some words of guidance, and some insights and some ideas that you might want to explore a little bit further. Let me start by saying this. The one constant that we know that we are all going to have in life is change. As a matter of fact, Peter Drucker once said something that I love. He said that we now live in the era of the 3 C's: accelerated change, overwhelming complexity, and extreme competition. Change is the one constant we're going to have in life. And part of that change, when it comes to investing, is that we're going to have cycles. We're going to have short cycles and we're going to have long cycles. And in both cycles, there's a constant. The constant is the market will go up and then the market will go down. For every investor, the question is, what do I do during those cycles? Now, in the last few days, there have been a number of market corrections. Perhaps I should rephrase that. In the last month and since the start of this year, if you follow the market carefully, within the digital assets investment class, particularly cryptocurrencies, there have been some market corrections. And for a number of people, that has been really a difficult time, a challenging experience, especially for those who perhaps have not gone through such cycles or perhaps haven't encountered anything as severe as that. And so what I'm going to try and do is not just answer the question about what should I do in cycles, but try and perhaps provide an insight as to the positives and the negatives in a cycle. And then you might be thinking, how can there be a positive when there's a down cycle? Well, if you stay with me for a few minutes, you perhaps see that there's a good and there's always a bad. Some people call it the law of polarity. You can't have darkness without light. You can't have good without bad. They come together like two sides of a coin. What matters is what side you're on, but more importantly, whether you have the intelligence to stand on the edge of the coin, because that's where real intelligence gets tested. Can you hold two opposing ideas in your mind at the same time and still retain the ability to function and think? Well, let's get started. A down cycle is a euphemism for what we say is when you lose a lot of money. A down cycle, a market correction, is just another way of saying the market crashes and some people lose money. Now, if you're one of those perhaps who you see on a day-by-day basis all of your assets and your investments and perhaps part of your net worth go down, then I'm going to take it a little bit further, because you see, the market crashing or the market correction is not a problem. It's a symptom that there is a problem. And that's what I want to deal with, because you see, one thing we learn about history is that history doesn't repeat itself, but it does rhyme. And any intelligent and experienced investor will tell you the markets go up and the markets go down. So it's nothing new. So my first question to you is, if you're in a position whereby perhaps a lot of what you've invested is, and I hate to say this, getting wiped away, here are some thoughts. And I'm going to take you back to the basics and back to the beginning. I don't believe in just dealing with symptoms. Let's deal with the problem. I'll start with this. One of the most important factors of investing is recognizing that it's not what you buy that matters, it's what you pay. And the key to success in investing from a quantitative basis is always to buy things at a price that is way below the intrinsic value or the worth. But more importantly, buy things that have a demand, so that over time, you'd find that the intrinsic value would increase and the demand would also increase. But the key here is buying below the intrinsic value. Now let me use this analogy for example. Let's say you're about to buy something and it's at this price. Let's just use that as an example. But let's assume that its intrinsic value is just above its price. The question is, what should you pay? Now, if you were to pay a price below its intrinsic value, that would be the right approach. However, the most important factor is not what you pay, but how much of a margin of safety you include in what you pay. A margin of safety is simply allowing some, what I would call contingency, some tolerance, a degree of allowance between what you pay and the price. And a margin of safety is something that Benjamin Graham, who a lot of investors would agree is perhaps the father of value investing. And he talks about the margin of safety in an interesting way. I find that having the right margin of safety does two things. Number one, it ensures that at the point when you buy, because you're buying at a price below the price, you automatically make a profit because that price you're paying is also way below the intrinsic value. So you make a profit. But the second thing it does is, I think, quite interesting and even more important. Paying at a price below the market price and below the intrinsic value ensures that when there is a market correction, it protects you from the downside. In other words, it limits your loss. So during the upside, during up markets, it maximizes your gain. During the down markets, it minimizes your loss. So in a correction market, if you find yourself in a position whereby your assets perhaps are depreciating in perceived value and you believe you're losing money, my first question would be, what margin of safety did you include when you bought what you have? See, a lot of people get into investing emotionally. Investing is an intellectual game. It's not an emotional game. It requires the ability to be an independent thinker. And that simply means that you make decisions by consulting one person and one person alone. The person who stands in front of the mirror when you look at it. And that's you. Now, if you bought and you haven't allowed for enough of a margin of safety, then there is a possibility that as the market corrects, that you might have a little bit of a correction to your assets. But here is the point, and I think this is the most important point. Every market corrects. And it's important to recognize that one of the most tragic decisions most people make in investing is they decide to buy at the top, buy when it's really high. And when the market corrects, they get emotional and they sell when it's very low. And I can't explain how challenging that is. The difficulty with that approach is this. When you buy at the top, you're what we call the greater fool. You must forgive me for using such a word. Unfortunately, if you sell at the bottom, you are even a bigger fool. For the primary reason that, unfortunately, you don't participate in the upcycle. Now, if the market is going to go through cycles, then it means, in many cases, all you have to do is exercise patience. Now, if you're patient, and if you have good emotional control, then what simply happens that over time, the market will keep going down and eventually it will start to rise again. Now, here is what I find fascinating, and this is where I move over to the advantages of market cycles. Whenever there is optimism in the market, that is the time when most good investors take a step back and say, you know what, we're going to wait this out. There's too much optimism in the market. So we become fearful. Whenever there's pessimism in the market, which is when you have a correction or when the market is going down, good investors become aggressive. And at such times, as an investor, you don't need skill. What you need is to combine aggression with timing. Why? Because you see, optimism is the enemy of a good investor. If everyone is optimistic, the market is optimistic, the prices will continue to go high. Now, if you bought at the bottom, you want optimism on your part because it means as it goes up, you're making more money. But the key then is every investor recognizes that at some point, the market gets unstable. There's too much optimism, and you know that at that point in time, perhaps this is where the value was initially. The price is reaching up to a level that you know is way beyond its intrinsic value. And you simply recognize that there is a constant as well that exists, and that is price and value will always converge. It might take time, but they will. Price would either go down to meet value, or value will go up to meet price. One of the two. But when there's been a lot of optimism, most investors decide at that point in time that this is the right time to step away from the market, so they sell. And as a result of that, it sends out a signal to the market, and somewhat the optimism is reduced, and then the market starts to perhaps decline. And unfortunately, the emotional investors read that as a sign that the market is crashing, so they start to panic and they sell. But here is the problem. They are selling on the downside. And as they keep selling, the market keeps crashing. The good investors are waiting patiently, excited. Why? Because now there's pessimism in the markets. And now they're going to get really aggressive and they're going to come in and rebuy their position. The point I'm trying to make is this. Investing is a game. There are rules to the game. Think about this, for example. If you were going to travel to some part of France where they don't speak English and you wanted to be successful in France, what is the first thing you would have to do? You'd have to learn French so that you can communicate. I get really shocked and surprised at the same time with people who want to invest and they don't learn the art of investing. And that is the first thing you have to learn, that it's a game. And success comes from understanding the rules of the game. Because if you don't understand the rules of the game, I promise you that you're like an amateur playing against professionals who know the rules. And unfortunately, your loss is inevitable. Now, the point I'm trying to make is this. For the intelligent investor, market corrections are the perfect time for them to get back into the market and buy what they've been waiting for so long. But let me bring this to a close by leaving you with, I guess, some nuggets of wisdom. And here is the point. I made reference to the fact that it's not really what you're buying, it's what you're paying that matters. That is quantitative. There's a qualitative side to investing. I'm not going to go into it in this session, but let me just leave you with some insights. When you're going through a market correction, one of many things happen. You get alert because now you have a lot at stake. And at that point in time, you've got all these juices flowing through your body and your brain. You're thinking. Perhaps you have more of the emotion of worry and fear rather than optimism, but it's a great time to apply the principle of critical thinking, which is sitting back and saying, knowing what I know now and using hindsight as a guide, did I make the right investment choices? Let me address that. Number one, if you've invested using leverage, in a down cycle, I know it can be very difficult. The reason is because the market can remain random and inconsistent and cyclical longer than you can hold your patience and stay solvent. So if you're using leverage, it's a good time to sit down and say, what if the market goes down by another 25%? Could I survive with what's left in the portfolio? What if it goes down by 50? What if it goes down by 75? What if it goes down by 100? What if I lose it all? And that is a good time to understand that leverage needs to be used with financial intelligence. Now, this is not something perhaps you're going to do immediately, but it's a good way for you to sit down and say, in the future, one of my new principles is I'm never going to use leverage for and in a speculative market, because that is what digital asset investing is. It's speculation with perhaps some level of intelligent principles and investing principles being used, but it's purely speculation. Leverage should be used intelligently. The second question that you should ask yourself is this: if I hold on to my portfolio for the next 2 months, for the next 3 months, for the next 10 years, will I get the opportunity to participate in the upcycle? If the answer is yes, then you have to hold. Hold your position. What you want to try and understand is, how long is that waiting time going to be? Unfortunately, I can't tell you that. The market is irrational. I don't know. There's a lot of randomness in the market. Recognize this. In every marketplace where the behaviors of the participants keep changing, the landscape changes, it alters. Particularly in digital assets, we have a lot of very emotional investors, and so there's no way that I can tell you how long the down cycle will last. What I can promise you is this: if all of us who have undertaken perhaps investments using sound principles, and we've done our due diligence, we've applied good philosophies and principles, we've applied the process of thoughtful portfolio construction, we've done an execution that was right. More importantly, we've applied good judgment with patience and the willingness to stick to what we believe in. If we hold our position, the market has no choice but to correct. So I believe one of the things you should do in a down market is ask yourself those questions. Now, there's another thing you could do during a down market. It could be the best shopping opportunity of a lifetime. Now, it's not for me to tell you whether to go out shopping. I will say this. At the start, I mentioned the importance of having your margin of safety when you're buying. And if we're at the lowest point we're ever going to be in the market or in any market, then it means you can get things for what back in the day people might say you buy things, maybe a $50 bill, a $1 bill for 50 cents, or perhaps a $1 bill for 25 cents. And that's what the market is offering right now. An opportunity for you to get what you've been expecting or hoping to get for the right price and way below the intrinsic value. Recognize something, that every good investment uses time as an ally. Time is a friend of a good investment, and for a simple reason. If you invest in a good asset, it will compound over time. So even when you go through a down cycle, once the market starts to correct, the compound process escalates, and then you actually find yourself in a better position than where you were previously. The downside is that in a bad asset class, time is not your friend. And unfortunately, in a down market, if you have a bad asset, there's a possibility that it might go right down to zero. I can't tell you what to do in that instance. What I would say is this: if you sit down and you cut off all the noise, including myself, You put away all the videos, you put away all the philosophies of other people's and other people's opinions, and you just sit down and you listen to the still small voice in you. What you might find is that you hear a voice that guides you on what to do. Recognize this. The decision has to come from you. You've got to accept complete responsibility. I love down markets. I love all markets. Down markets are great opportunities for me to sit down and say, let me review my portfolio. Let me review the assumptions I made. The assumptions I made at the time of purchasing these assets. Based on what I know now, were they the right decisions? Now, this is what I believe, for me, is the most important thing. Making and doing those reviews provide me with what I call invaluable principles. I write them down. Reason being, I know the market will repeat itself. And so should this moment come again, I don't have to think about what to do. I can make reference to my past experiences. But in addition to that, during market times like this, I look back at my portfolio and say, is this the right time to be defensive, or is this the right time to be aggressive? By defenses, I simply mean take a step back, don't do anything, don't be irrational, be patient. Don't get into the market, don't increase your stake, don't increase your position. Or is there a right time to be aggressive? In other words, is this the right time to go all in? Perhaps increase my stake, increase my level of equity in a particular investment. In many times and in many cases such as this, it has less to do with what asset you're buying and what you're offloading. It comes down to a simple principle. Is this, my friend, a time to be aggressive, or is this a time to be defensive? Now, only you can answer that question. And I hope you make the right choice. I wish you the best.